If you look at the drop here on Tuesday, the next day, at Wednesday, we have a candlestick high here. Now watch. That is your SIBI. This is your sell side imbalance, buy side inefficiency. This big displacement lower here, this up close candle and this up close candle, that makes all one singular bearish order block. It's not the last up close candle. There are times where I will do this, and the rules for using the up close candle, the last one before the drop down, that definition will be in my book because it's in written format. Because of this displacement lower, we can't use this candlestick high here to that candlestick's low. We have to refer to the truest beginning point of the order block, which is this run up. Okay, something here came into the marketplace that was unbeknownst to me. I don't care. I'm not trading in the morning session, but I saw what it was doing. So I went in and I worked with the position of getting short inside of this daily range, the latter portion of it, the afternoon session, post 1:30 p.m. Eastern Standard Time. So we have to look at this candlestick here. So what 3 price points here on this candlestick are pertinent or useful? The difference between this candlestick's low and that candlestick's low. Okay, you see that? What is that? That's your fair value gap. This is just a SIBI. This is a fair value gap. The low here to that candlestick's high, that is that's your real fair value gap. Other folks on the internet may see this and say, okay, ICT says that the best portion of shorts are going to occur in the lower half of that, and we'll leave the upper half open. And that is true when you're trading and utilizing a fair value gap that is a SIBI, but that is not what's going on here. That's why I tell you all the time, there is no one trick pony explanation for a fair value gap. You have to understand other factors and other PD arrays. That is not what we're seeing here. This is a change in the state of delivery right there, that opening price. In a perfect world, price would do this. It would trade up to that level there, maybe just a little bit above it, and then roll over and go lower. That's the perfect world. But if we're thinking about things algorithmically, and I'm teaching you how to use these PD arrays properly, not look for an imbalance that completely closes in, then I'm going to go long or short based on that. That is the worst approach to doing that. There's more likelihood that your trade's going to fail if you trade like that than if you use the logic I'm teaching, which is you don't want to see them fill in. You don't want to see them fill in. So if this is the change in the state of delivery, that means the price was offered going up. So this is buy side delivery. That means the movement of price is going up. Then you have this displacement lower that overtakes that candlestick's low. Your reference point goes right back to that opening price. That's the change in the state of delivery. If you look at this price right here, September 3rd, and the price is being annotated here on that opening candle, August 29th. Okay, let's watch. We'll drop down to an hourly chart. You already see it, don't you? You see it? What's going on there? It's leaving all this open. Light bulbs are coming on. Right? Let me go back to the daily chart. I want you to fully understand what I'm showing you. This candlestick, that opening price, we're drawing that out in the future. So if we drop back down to a 60-minute chart, so here's that opening price on that daily candlestick, that little movement to the downside, and then it rallied up. And then we had that rollover on Tuesday. Right at this moment here, look what price is doing. It's opening and trading right back up to it. It's leaving all of this open, and it's leaving all of this open. So this inefficiency right here, and this inefficiency, it should never be traded to. Why would you expect these two fair value gaps to ever be considered at all if it's inside of that bearish fair value gap and it's above the change in the state of delivery? That means it's going to do what? It's just going to go into a little bit. And then you want to see these things stay open because that indicates that we're really heavy. Every little separation between 3 candles like this is not a fair value gap. It's not. This is further evidence to indicate that you have to have more intel about the other PD arrays because no matter which one you start with, it could be the breaker block. It could be a propulsion block. It could be a, volume bounce or fair value gap. You have to understand the other ones, even if it's a small little brief acknowledgement. Okay, I recognize it, but that's not what I'm going to trade on. You have to refer to it because it's part of the whole narrative of what price is doing. But these inefficiencies they're not going to fill. They're not even going to trade back to. You don't want them to. Now, because we have that, we can drop down to a 15-minute time frame. All right, so here's that opening price on the daily candlestick, and it's the change in the state of delivery, and you can see it wicking up into it. We saw on that hourly chart. Now we're on a 15-minute time frame. It's trading into it here, and that defines that 15-minute, or sorry, hourly inefficiency, the downside. It's just a SIBI. That's not a fair value gap that you trade. Okay, it's just showing an inefficiency, but just because there's an inefficiency doesn't mean it needs to trade up into it. You want to see where you are in the lay of the land. Where is price at? Where is it likely to go? And how's it been delivered? These two inefficiencies in price, we don't want them to trade to them. We don't want to see price go up there. But watch what happens when it starts to break lower. After returning back to that blue line, which is the opening price on the lower up close candle on the daily chart that frames the full bearish order block. This is what you end up doing with this information. Okay, this is all part of the price delivery continuum theory. Knowing what you're looking for from one higher time frame, and then using the information from that higher time frame, what should you expect to see in price? So it gives me the confidence. It gives me, I know what I'm looking for. I know what I'm going to trade off of. I know how I'm going to place my stop based on this information. Big, huge paradigm shift. Ready? So it trades up into the opening of that lowest up close candle that makes the bearish order block. This is the change in the state of delivery. The algorithm is going to refer back to that price. Here we are on a 15-minute time frame. Does it wick above it? Yes. Does it wick above it? Yes. Does it wick above it? Yes. How can you validate that that is really going to be an influential order block, ICT? Look at this lower time frame. What are the bodies doing? What are they doing? Are they just going through it? No. They're respecting it. Oh, so if I can see a time frame like this that's confirming it, that means this up close candle becomes a valid bearish order block, and then I can use its opening price. We get that on that candlestick right there. We don't need a close below it, so that validates this as an order block. But now watch, when it does this, the next candle, what does it create? What's this? That's your first presentation. Oh, so it's not limited to 9:30 to 10 o'clock. Right. It's when you're using proper breakdown from a higher time frame down to a lower time frame, using the PD arrays in the proper context and its PD array matrix, where we're at in the lay of the land, that fair value gap, you can trade that right there. Where's your stop go? It's got to be above the order block, because it should not go back above that, especially now because we had this candlestick go above it and this candlestick goes above it. But prior to it validating that closing or that opening price, it didn't need to close above or below it. Let me say that one more time because I just gave a whole bunch of contradicting statements. This candlestick up close is your bearish order block. We don't know that yet until this candlestick crosses down below the opening price. It does not, on this candlestick, it does not need to close below the opening price of that to validate that as a bearish order block. What's good about this is we had this candlestick already trade above this up close candle, which is a potential, we don't know it yet, bearish order block. It wicked above its high there, and it wicked above its high there. And then on this candlestick, we traded below that candlestick's opening. That validates that candlestick as a bearish order block. Any stop in this close proximity, you could use the opening of that candlestick right here. That right there, you could be entering, and you can add more into it into the fair value gap if it trades up into it. You know, that's what I'm saying. Like, you can use that as your entry mechanism. But for stop placement, you have to use the high of that candlestick plus one tick, and it never goes there. So that's your defined risk from this candlestick high minus one tick, that's your entry, to this candlestick plus one tick above its high. So that's your defined risk. And you can see multiple instances where you can get in and get short on that idea, that premise. So in reality, what we're saying is this candlestick's low and this candlestick's high. That's your real fair value gap. That's it right there. Now, let's think about this for a moment, okay? If that's your fair value gap, this is your high on the fair value gap, which is the low of the fair value gap, and this candlestick's low is the high of the fair value gap. So that defined range there, this section of price, is inefficient in what buy-side delivery because this candle moved lower. So in this little section of price action between this candlestick's low and this candlestick's high, we're only focused in this little shaded area. We wait for price to go up into it, because what is that doing? It's offering the sell side delivery. That means it's overlapping this down movement between this candle's low and this candle's high. It's inefficient because it didn't have any other candlestick cross over the range defined by this candle's low and this candle's high while price was going up. That's why I use the analogy all the time, painting. You roll the paint down And then you're going to have these little porous pockets where it didn't create a very smooth delivery price action. We'll see that when we drop back down to lower time frames. But here it looks, you can't see that. So the only way you can see it on this time frame is defining with a fair value gap, which is why I created that concept. Then this run back up into it is overlapping that, even though it wicked and went lower, that delivery right there, that's what I'm studying that. What did I teach you about turtle soups? They're reversal patterns and they're continuation patterns. You can use the fair value gap to get into a turtle soup. All right, so my focus and aim was, that was this one, and then the next one is this one. That run above that, that's my turtle soup. So if I'm looking for this level down here, which I'm going to label this line with a black level. So between this candlestick's low, this candlestick's high, something in here, I want to attack it. I'm waiting for them to give me a high, a short-term high around time of day that I want to trade. And then I'm going to wait for it to pierce that high. That's turtle soup. This candlestick's high, my entry going short has to be above that, as much as this candlestick's low. So I have a range of looking for a short in that general proximity. Okay, so now drop hourly. So we have this old high, and inside this range here, what's it reaching for? When it wicked up like this, what is it reaching for? Look over to the left. What is all this? That was me framing the order block up here. And then you have all these wicks, which becomes what? Balanced price range. Why? Why is this balanced? Because we have this candlestick opening, trading up here. We have this candlestick opening and trading up here. We have this candlestick opening and trading up here. So essentially what you're seeing is you're seeing a wall of price action that's been delivered here. It's offered buy side and sell side all throughout this range here. And then it leaves it right there. So that means that I can take that idea and say, I'm going to extend this over here. And once it gets into that area, it should have no easy path into all this stuff or higher. So now I'm further refining this down into a small little pocket of price range. So yes, it can touch this, but before we get to that range, when it's trading above this high here, when it's doing this movement on the hourly, what can I use as an initial framework to say, okay, where's my focus at? It's going up to this level, an extreme level, but it's going to have a real hard time getting above that because we've seen back and forth individual candlesticks overlapping in the same range. Then we have this right there where it leaves that balanced price range and it leaves this little tiny little section of price action exposed with inefficiency. What is it inefficient in? It's sell side delivery, but buy side inefficient. That means it's got to have at some time in the future after this candlestick closes and this one starts to efficiently offer the market fair value pricing. This gap is what it is, should be repriced to with buy side delivery. That means movement up in price, and we get that here. So now we have this wall of price action. We're going to take that away because it's going to confuse you. This fair value gap, we're going to drop down into a 15-minute time frame. This is all top-down analysis. So here's that high, and this gap here is above this old high, and we're trading up. I want to try to take a short as it's trading higher. As it goes higher, I want to sell short into that because it's going into that inefficiency. I had that big wall of price action. Remember on the hourly chart? It's all those wicks that was saying I'm a balanced price range. It might touch me, but I'm not going anywhere. And I'm going to keep price from going any higher. But the wicks can do what? They are allowed to do the damage. That means they can color just outside the lines. But more importantly, my focus is I'm getting above that high right there. Because this is all part of a daily fair value gap, institutional order flow entry drill. That means I expect it not to completely close in a bearish fair value gap. I want to see it just go in a little bit, like it's doing right here. And I want to see it immediately send price lower. Okay, now we can drop down to a 5-minute chart. If I'm watching this time frame, what do I want to see in price? Well, what does my price delivery continuum theory teach you? The previous higher time frame gave us this pink shaded area for the fair value gap to be defined. And now because it's transposed to this time frame, now we're on a 5-minute chart, what are the bodies telling me? They're respecting it, aren't they? So I'm getting closer and closer to what it is I'm looking for. Because every frame of reference for time, because that's the most paramount thing, time is the most important factor before price does anything. Because if it ain't the right time, price ain't going nowhere, period. The bodies are saying, yeah, we're respecting that. We're not going to color outside the lines, but the wicks will. Whatever the higher time frame PD arrays have done at a higher time frame chart, the lower ones should start respecting that PD array as you see here. Are the bodies going beyond the PD array that I'm using to anchor my analysis on the higher time frame chart? No, it doesn't do that. When you're looking at a fair value gap, how far can it go outside of the range that defines that fair value gap and still be good? How wide is the fair value gap? Because the wick can do that range outside of it. That's one standard deviation on the fair value gap. That is not changing anything for me. The fair value gaps, when you're looking at them like this, they're being refined smaller and smaller and smaller. They're not going to go 5 times this, okay? And then so it's a good trade. It's going to be within the realm of whatever this fair value gap width is. It can color outside the line that much. Generally, it won't do that much at all, but that's the rules for it. So watch what happens when we use the same logic going down into the 1 minute chart. So now look what we have here. Right away, students of mine that have been with me for a long time know that this is a market maker sell model. Where's your consolidation? Right here. Why are you picking that, ICT? Why aren't you using this down here? Because this is all impulsive price action. It's real sharp. We don't want that. Our eye goes for the original what? What's the rules for a market maker sell model and buy model? The original consolidation. That means your eye is looking for a perfect little box of price action. Well, can you see that this to this, those are relatively equal lows, right? Go straight up from there. What do you have? That's your original consolidation. Inside the original consolidation, go back to the original rules. This is old stuff. It can drop down slightly below that low right there, which is what you get. And then once it leaves it, it can touch what? The original consolidation high. Expansion up, reaccumulation. I'm sorry, first stage accumulation, reaccumulation, or second stage reaccumulation. Then it rallies up and creates what? Smart money reversal. So when price is trading up into this area, what time is this time of day? It's after the opening range of 9:30 to 10 o'clock. So we now have the market trading inside of our fair value gap. But now that's the first time it can trade there. So anyone that wants to go short, just because it rallies up higher like that, you got to wait. Just give it a chance. Give it a chance to let people go after it, because it's the second mouse that gets the cheese. This is the cheese right here. It's baited. That's the area that everybody would want to get if they understood what I'm teaching. They want to get that price level. It's real high. It's nice. But they don't understand the market maker sell model, which is consolidation, maybe a stop hunt initially, rallies, touch the original consolidation, rally higher, accumulate. Second stage reaccumulation. Then it rallies and takes out a higher high right there. It's coloring outside. We saw it on the hourly. We saw it on the 15-minute time. We saw it on the 5-minute chart. There was wicks up here, right? That's what these bodies are on a 1-minute chart. That is completely permissible. We're not going to look at the bodies of a 1-minute time frame when the higher time frame, hourly, 15-minute, and 5-minute, are showing just the wicks. But watch, when price takes out this high here, and we're inside this area as well, I want to be selling short. I want to get short in there. I want to add more if it can afford me outside the coloring of that shaded area. That's premium pricing. So now when we have this smart money reversal, you don't need that. Wait for it to break in market structure. That's what you get with this little high here. I'm sorry, this low. We get it right there. And then we trade back up into what? The order block. Where's the change in state of delivery on that? That opening price on that candlestick right there. So if this is in fact correct, any little retracements up should not take out this high. And our premium array that's inside this as well, like this order block. Every time we worked inside that, what is it doing? How do we use PD arrays? If it's a premium array, we want to see the lower half of it utilized and the upper half, ideally, not touched. It's working the lower half of the discount portion, and it's under the mean threshold. If you're bearish, up close candles at the halfway point and lower. That's where all of your institutional buying and selling is going to be weighed on. We have that bearish order block validated here. So that means from that opening price, anything above that is a potential entry. But ideally, it should never go above the halfway point, which is mean threshold. See how it's doing that? I want to see it attack all these pools of liquidity. The market is pausing in here, and it's all time distortion. Time distortion is where the market's being held in a holding pattern. All of this is potential areas where you could take a short entry. Look at the price right there. I know I'm getting real premium pricing here because I'm outside of that fair value gap. Above this high, this is turtle soup. This is where smart money does the smart money short. Low risk sell order block. The high end of that fair value gap, that's what I'm aiming for. And I'm targeting right in here in this wick. And then I'm aiming for this low to be taken out. And I said the market will aggressively reprice down there because the algorithm is not going to want them to pull their orders. So below here is sell side and below here is sell side. And then we have the original consolidation here. So that would be you aim for a run below here. So you see it drop down. That's wonderful. So this is the first stage distribution, and then this is second stage distribution. Second stage distribution is your unicorn. It is so quick. It's so powerful. If you trade the second stage redistribution, that means you're selling short. Or if you're buying the second stage reaccumulation, that means you're going long. You are going to get the biggest, the fastest, the beautiful, easy hold trade that you're looking for. Everybody knows these relative equal lows are there, but not everybody sees the framework that causes this to be second stage distribution. What's this? It's a discount wick. But what happens if you're below it? It becomes what? A premium wick. How hard can it go above that? Well, you have a little bit of inefficiency here, but then you're met with what? Balanced range. This wick, previous wick, all this is balanced. So it's trading up into it, but it's saying, I'm not going to let you go any higher. You're going to stop right there. Turn it around, bro. And then rolls over. Where's it aiming for? Original consolidation. What's below these relative equal lows? Sell side.